Imagine having a playbook that could help you not only navigate the unpredictable world of the stock market, but also build a solid financial future. The Intelligent Investor is that playbook, and it's so powerful that even Warren Buffett, one of the most successful investors of our time, learned from it. But have you wondered, what was so important that Warren Buffett even recommended this book to read? What valuable lessons helped him become a market legend? Today, we'll explore these invaluable 7 lessons through real-life examples. By the end of these lessons, you will be surprised at how simple methods can change your approach to investing. So, why is the Intelligent Investor important in the world of finance? Picture this. You're on a turbulent flight, and your pilot calmly explains the safety measures in place. That's what this book does for your investments. It's your financial seatbelt in a volatile market. All right, let's uncover its important lessons. Lesson 1. Stocks versus bonds. Let's begin by understanding the concept of stocks. What exactly is a stock? Imagine a pizza. A whole pizza represents a company. This company has divided itself into smaller slices. Each slice is like a tiny piece of ownership in the company. These slices are what we call stocks. So, if you own a stock, you own a small slice of that pizza, company. Just like with pizza, the value of your slice, stock, can go up or down based on how well the company is doing. If the company is successful, your slice becomes more valuable. If the company isn't doing well, your slice might be worth less. And here's the exciting part. You can buy and sell these pizza slices, stocks, in the stock market. So, when you buy a stock, you're essentially buying a piece of the company's future earnings and success. Now that we've got a handle on what stocks are, let's turn our attention to bonds. Imagine you're helping a friend by lending them some money. When you do this, you give your friend a specific amount of money with a clear promise. Your friend agrees to pay you back the money you lent them, and they'll also give you an extra thank you gift as a token of appreciation. Bonds work in a somewhat similar way. When you buy a bond, you're essentially lending money to a company or the government. They promise to pay back the money you lent them, the principal, after a certain period, which is like when your friend returns your loan. Plus, just like your friend might give you a small gift, the company or government also pays you interest for using your money. This interest is like your thank you gift. So, now that we have pizza slices, stocks, and friendly loans, bonds, you might be wondering when to invest in stocks and when to consider bonds. Let's break it down into a simple rule of thumb. Think of stocks as the engine for long-term growth. If your financial goals are far in the future, like retirement that's decades away, stocks are like the turbo boosters. They have the potential for higher returns, but they come with more ups and downs. So, when you have time on your side, consider investing in stocks for the long run. On another side, bonds as the safety net. They offer stability and regular income. If you're closer to your financial goal, like buying a house in a few years or funding your child's education, bonds act like the reliable brakes in your financial vehicle. They help you slow down and reduce the risk of losing money when you can't afford market turbulence. A practical approach is to use a mix of both stocks and bonds in your investment portfolio. The closer you are to your financial goals, the more you might want to shift toward bonds to protect your money. As you have more time on your side, consider adding more stocks for the potential of higher long-term growth. Remember, it's not about choosing one or the other. It's about finding the right balance that aligns with your financial goals and risk tolerance. By following this simple guideline, you'll have a clearer path to make informed investment decisions. In addition, I also suggest exploring other investment options like mutual funds, real estate, crypto, forex, commodity. It's important to understand and calculate the potential profit percentage for each option. So, keep learning. Now that you have a basic understanding, let me introduce you to a fascinating concept from Graham's book called Mr.Market and how you can take advantage of this concept in real life. Lesson 2. Mr.Market. Benjamin Graham presents an interesting concept in his book called Mr.Market. You might be wondering, who exactly is Mr. Market? Is he a real person? Mr. Market is a metaphorical character used by the author Benjamin Graham to represent the stock market. Mr. Market is described as a moody and emotional individual who offers to buy or sell stocks at different prices every day. Picture Mr. Market as your eccentric neighbor. One day, he offers you $1.10 for your $1.20 bill, and the next, he'll give you $50 for the same bill. The point is, he's irrational, and Graham's lesson here is to not let Mr. Market's mood swings dictate your investment decisions. This means that the stock market can be unpredictable and volatile, with prices changing rapidly based on various factors such as news, events, and investor sentiment. Now, you might be wondering, how can we take advantage of Mr. Market's irrationality? Let's say you've done your research and determined that the fair value of a company's stock is $50 per share. However, Mr. Market is feeling pessimistic and offers to sell the stock for $1.30 per share. This is a great opportunity to buy the stock at a discount and hold on to it. Now, let's say Mr. Market's mood swings in the opposite direction and he becomes optimistic, driving up the stock price to $1.70 per share. This is your cue to sell the stock for a profit of $1.20 per share. By buying low and selling high, you've taken advantage of Mr. Market's emotional behavior and made a profit. However, it's important to note that this approach requires discipline and patience, as it may take time for Mr. Market's mood swings to work in your favor. You may be wondering how to choose a best stock from the vast number of options available in the stock market. What is the secret to selecting the best stock? Fortunately, Graham also covers this important topic in the next lesson, which is called Fundamental Analysis. Lesson 3. Fundamental Analysis. As Benjamin Graham wisely puts it, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Graham introduces a crucial concept called fundamental analysis. But what is it? Why did Graham mention it? And how can you use this lesson in real life? Fundamental analysis is like peeling the layers of an onion to reveal its core. It's a method of evaluating a company's financial health by digging into its financial statements, earnings, assets, and liabilities. In essence, it helps you understand the true value of a company and its growth potential. Benjamin Graham emphasized fundamental analysis because it's the foundation of intelligent investing. By thoroughly assessing a company's fundamentals, you can make informed decisions rather than relying on market sentiment or short-term trends. Graham's approach seeks to buy stocks when their prices are below their intrinsic value. Now, how can you use this lesson in real life? Here's how, with a simple example. Imagine you're considering investing in two lemonade stands, Stand A and Stand B. Both seem promising, but their financials are different. Stand A has a consistent history of making $1,000 in profit each year, while Stand B's profits have been all over the place, ranging from $500 to $1,500 annually. Fundamental analysis encourages you to assess which stand is a more reliable investment. By looking at Stand A's consistent profits, you can estimate its intrinsic value and decide that it's a stable, long-term investment. Stand B, on the other hand, is riskier due to its inconsistent earnings. Fundamental analysis suggests it may not be the best choice for a long-term investment. Benjamin Graham emphasized fundamental analysis because it's the foundation of intelligent investing. By incorporating fundamental analysis into your investment strategy, you can make more informed choices. Rather than following market fads, you'll be investing based on real data and long-term value. Remember, Benjamin Graham's emphasis on fundamental analysis isn't just a concept. It's a practical tool that can help you navigate the stock market with confidence. Now, imagine you've done your research and found the perfect stock to invest in. But what happens when the market experiences fluctuations? What if the price of your stock suddenly drops? How would you handle such situations? This is where Graham's lesson on market fluctuations comes in, providing valuable insights on how to navigate these challenges. Lesson 4. Market Fluctuations. Picture this. You have a favorite restaurant that serves great food, but it can be packed one day and almost empty the next. Do you change your opinion about the food's quality based on the daily crowd? No, right? Graham advises you to apply the same principle to the stock market. Benjamin Graham doesn't just teach us to invest, he shows us how to harness the power of market fluctuations. But how do you take advantage of these market ups and downs, and what should you do in the long run? Market fluctuations are like the changing seasons. They're a natural part of the investment landscape. Instead of fearing them, you can take advantage of these fluctuations in a few ways. First, buy low, sell high. When the market is down, stocks often become more affordable. It's like a sale at your favorite store. Consider buying quality stocks at discounted prices during these times. Second, stay rational. Don't let emotions drive your decisions. Fear or excitement can lead to hasty choices. Staying calm and rational can help you make sound investment decisions. And last, value investing. Follow Benjamin Graham's value investing principles. Look for stocks trading below their intrinsic or fair value. These are often hidden gems waiting to be discovered. And remember, if you've already done your fundamental analysis and the company is strong with all the data in line, then market fluctuations during the season can be your ally. Now, assuming you have picked the best stock and have also handled market fluctuations using Graham's strategy, but you still want to be on the safer side and reduce the risk of losing money. What can you do? Here comes the lesson on margin of safety, which is really interesting and can help you have an extra cushion. We will cover the next lessons including margin of safety, different investment styles, and the one of the important lesson on value investing, so you will stay on the safe side while investing and reduce the chances of losing money in next part. But that's not all. We'll also be putting these lessons into practice with a real-life example. You won't want to miss it. If you found this summary helpful, please hit that like button and subscribe for more book summaries and investment insights. And remember, Benjamin Graham's timeless wisdom is just a book away. Happy investing, and I'll see you in the next video.